Many traders feel overwhelmed by price movement and unsure of where or when to enter. They chase setups, react emotionally, and often miss the bigger picture. If that sounds familiar, don't worry. In this video, I'll show you how to bring structure to your trading by reading the market the right way. It's a strategy based on 3 simple elements: trend, level, and signal, also known as the TLS method. This is for educational purposes only, not financial advice. My goal is to help you see the market more clearly and trade with more confidence. Alright, now let's break this strategy down step by step, starting with the most important element in trading: understanding the trend. Before you even think about entering a trade, you need to know what the market is doing. You see the market making lower highs and lower lows. It's clearly in a downtrend, but you try to buy, thinking it might reverse. Instead, price keeps dropping and you're caught on the wrong side. Later, the market is trending strongly upward, breaking structure, pushing higher, but you try to sell, assuming it's overextended. Price keeps climbing, and once again, you're stuck in a losing position. This is what happens when you go against the trend. And the trend always wins. That's why the first component of the TLS method is trend, and to trade effectively, you need to be able to identify it within seconds of opening your chart. So let's do a quick, essential revision that will set the foundation for every trade you take. There are 3 types of markets you'll encounter: uptrending markets, downtrending markets, range-bound markets. Each one tells a different story. Your job is to understand the story the market is telling so you don't get caught trading in the wrong direction. In an uptrend, price moves in a clear staircase pattern. It makes a series of higher highs and higher lows. That simply means each peak is higher than the last one, and each pullback doesn't go lower than the previous low. This is a sign of strength. It shows you that buyers are in control and demand is pushing the market higher. But here's the part most traders miss. An uptrend isn't just a straight line. It moves in 2 waves. The impulsive move, this is the strong push upward. It's aggressive, fast, and usually driven by heavy buying volume. The retracement move, this is the temporary pullback. Price dips slightly, either to take a breath or to trap emotional sellers before launching higher again. If you know how to read these 2 phases, you can start positioning yourself with the trend, not against it. You don't chase the impulsive leg, you wait for the retracement. That's where opportunity lives. Now flip the script. In a downtrend, the market prints lower highs and lower lows. Each rally is weaker than the last, and every new drop breaks below the previous support. This tells you one thing: sellers are dominating the market. And again, just like the uptrend, a downtrend is made up of 2 types of moves. The impulsive move, strong, clean drops in price. These are driven by aggressive selling and panic exits from buyers. The retracement move, short-term rallies that suck in late buyers before the market collapses again. If you're trying to buy during a downtrend just because price is low, you're asking for trouble. You must identify whether the market is pulling back or breaking down. The third type is the sideways market, also called a range. Here, price is bouncing between support and resistance with no clear direction. Neither buyers nor sellers have control. It's a tug of war. In this environment, you won't see higher highs or lower lows. You'll just see price bouncing back and forth, faking out traders on both sides. This is where most retail traders lose money, because they're trying to force trades where the market isn't offering anything. So when you identify a range, your job is simple. Be patient. Wait for the breakout or rejection before getting involved. Now that you've learned how to identify the trend, it's time to move to the second component of the TLS method: level. And the first levels you need to master are the most basic, but the most powerful: support and resistance. Support is a level where price tends to stop falling and bounce back up. It acts like a floor. Buyers are willing to step in and defend that area. Resistance is the opposite. It's where price tends to stop rising and pull back down. It acts like a ceiling. Sellers come in and push the market down from that level. These zones are not just lines on a chart. They represent real buyer and seller interest. They're the battlegrounds of the market. Now let's walk through how support and resistance form specifically during trending markets. When the market is trending up, it moves in waves. Impulsive moves pushing higher, followed by retracements pulling back slightly before another leg up. Let's say price is climbing and then it slows down. It reaches a temporary peak and starts pulling back. That peak, where price couldn't go any higher, becomes a resistance level. Sellers stepped in there, or buyers took profits, and the market paused or reversed temporarily. Now, here's the key part. after that pullback, if the market regains momentum and breaks above that previous resistance level, that same level now becomes support. We call this a resistance turned support level. Why does this happen? Because the market just proves that it has the strength to push higher, and when price comes back to that zone, many traders see it as a chance to buy the dip. They remember that price broke out from that level, so they expect it to act as a launchpad for the next move. This is how powerful support zones are born, from broken resistance. Now flip the scenario. In a downtrend, the market is making lower highs and lower lows. It pushes down in an impulsive move, then retraces slightly upward. That lowest point just before the retracement began is a support level. Price paused there before pulling back. But if the market then loses momentum again and breaks below that support level, what happens? That level now flips into resistance. We call this a support turned resistance level. So next time price climbs back up and retests that same level from below, traders are watching. Many will look to sell from that area, expecting the downtrend to continue. Why? Because it's now seen as a barrier, a zone where price was previously broken and where sellers might defend the move again. These flips, resistance turning into support and support turning into resistance, are not random. They happen because of trader behavior. Some traders who missed the initial breakout are now waiting to enter on the retest. Others who were stopped out may try to re-enter the trend at a better price. And many institutional players use these areas to trap late traders and build positions with better risk-reward. These levels are where decisions are made, positions are built, and traps are set. That's why, as a trader, your job is not just to draw support and resistance, but to understand how they form, how they flip, and what story they're telling you. In this strategy, once you've identified the trend, the next step is to find a reliable level to guide your entries. Sometimes price gives you clean horizontal support and resistance levels, like we saw earlier. But other times the market moves so smoothly that these static levels aren't clear. In this example, the market is clearly in a downtrend, but there's no obvious resistance level to mark the end of the pullback and the start of a new impulsive move. That's when you bring in one of the most effective tools for dynamic support and resistance, the 50-period simple moving average. Look at what happened next. As you can see, once the 50 SMA is plotted on the chart, the market pulls back, retests it, and gets rejected. This rejection confirms that the 50 SMA is acting as dynamic resistance. So when static levels aren't available or clear, the 50 SMA can serve as a reliable reference point to anticipate pullback rejections and ride the next wave in the direction of the trend. Let me give you another example. When the market is trending up, the 50 SMA starts to slope upward. It follows price action like a smooth rising path. Each time price pulls back during a retracement, it tends to approach or tap the 50 SMA. And if the uptrend is strong, price often bounces off the moving average and continues higher. That's because the 50 SMA is acting as a dynamic support level. It helps you pinpoint the end of the retracement and the start of the next impulsive move. In this case, the trend is up, the level is the 50 SMA. All you need now is a signal, like the engulfing trap or the fakey setup, to enter with confidence. We'll break down both of these powerful smart money signals in detail, so don't skip, watch until the end to catch every key insight. Now, let's talk about the third and final tool we use in the TLS strategy to identify powerful levels: the Fibonacci retracement. Sometimes the market moves so aggressively that it leaves you with no clean entry. There's no obvious support zone, the 50 SMA is too far below the price, and you're left asking yourself, where do I get in? Where could this retracement possibly end? That's exactly when the Fibonacci retracement tool becomes your best friend. It gives you a precise mathematical way to measure the depth of a pullback, and more importantly, it helps you anticipate where the next impulsive move might begin. As you can see in this example, when price retraced to the 50% Fibonacci level, it got rejected and took off. If you were waiting for a static support level or the 50 SMA, you would have missed this opportunity. In this strategy, we're only focusing on two key Fibonacci levels, the 50% level and the 61.8% level. These two are heavily watched by banks, financial institutions, and large traders. Let's say the market pushes up strongly with no clean pullback, just one big impulsive leg. There's no horizontal support. The 50 simple moving average is still too far below. So what do? You grab your Fibonacci tool, draw it from the swing low to the swing high of that bullish leg. Now look what happens. Price starts to retrace. It slowly moves down. Then it taps the 50% or the 61.8% zone and gets rejected. A bullish candle forms, momentum shifts, and price starts moving up again. That's your entry. You now have a strong trend, a Fibonacci level, and a signal. This tool gives you a precise level when price action isn't clear. And the same applies in a downtrend. Use it to spot where the pullback is likely to end and the next impulsive move may begin. You now have 3 powerful tools to define your levels: horizontal support and resistance, the 50 SMA as dynamic support or resistance, and the Fibonacci golden zone. Now all you need is a signal. And the first one we'll start with is the fakey setup, a classic smart money trap used to trigger explosive reversals. The fakey is one of the most deceptive price action setups used by smart money to trap retail traders and flip the market in the opposite direction. It creates the illusion of a breakout, lures in breakout traders, then snaps back aggressively, leaving them stuck on the wrong side. It all begins with an inside bar, a small candle that forms entirely within the range of the previous candle. This signals consolidation and creates tension in the market. Next, price breaks out of the inside bar, giving the impression that a strong move is about to begin. But then the trap is sprung. Instead of continuing, price reverses sharply, closing back inside the inside bar's range. That's the fakey, a fake breakout, a sudden rejection, and a powerful reversal in the opposite direction. There are 3 key variations of the fakey setup you need to know. Bullish fakey, price fakes a breakout to the downside, sweeping stop losses, then explodes upward with momentum. Bearish fakey, price fakes a breakout to the upside, trapping eager buyers, then collapses downward. Multi-bar fakey, sometimes after the inside bar, the market forms 2 or 3 small candles before the false breakout. This variation adds more pressure and fools even more traders. No matter the variation, the structure is always the same: a false breakout, a fast rejection, and a real move in the opposite direction. The fakey setup is all about recognizing the trap before it springs, so you can ride the reversal with precision and confidence. Now let's apply the TLS strategy using the fakey setup. Let's put everything together using a real chart example of the Euro-US dollar on the 5-minute time frame. As you can see, the market made a strong, impulsive move upward, followed by a pullback. Now pay attention. If we look left, we'll notice a resistance level that was previously broken and has now turned into support. This gives us a key level to watch, a classic support-turned-resistance flip, one of the most reliable structures in trending markets. So far, we have a bullish impulsive move and a support level formed from previous resistance. Now, let's add the 50-period simple moving average to check for confluence. We allow the market to continue its pullback, and as you can see, price drops right into the support level and gets rejected. But what makes this setup even more powerful is the clear fakey setup that forms at the level. Here's what we've got. Price rejects the support zone. The 50 SMA is acting as dynamic support. A clean fakey setup appears, a smart money signal that confirms rejection. This combination gives us a strong signal that the retracement is ending and a new impulsive leg is about to begin. Now, we're on the 5-minute chart, but let's zoom out to the 1-hour time frame to see if it aligns with our trade. On the 1-hour chart, you'll notice that the market is range-bound between a clear support and resistance. And most importantly, it just created a false breakout to the downside, which often signals a reversal toward the top of the range. This gives us confidence that price has the potential to move up, possibly break the resistance or at least reach it, which becomes our security margin. Let's mark this hourly resistance as our target zone and go back to the 5-minute chart. So now we have a 5-minute entry setup with a fakey at support, confluence with the 50 SMA, a higher time frame context supporting an upward move. To take this trade, here's what you do. Enter at the close of the 3rd candle in the fakey setup. Stop loss just below the fakey low. Target just below the hourly resistance. This setup gives us a 2-to-1 reward to risk ratio, with confirmation from both price action and multiple timeframes. Look what happened next. The market respected the support, honored the fakey signal, and launched upward, hitting our target perfectly. That's the power of the TLS method: trend, level, signal, executed with precision, guided by logic. Now let's break down another powerful trade setup using the TLS method, this time with the engulfing trap as our signal. The engulfing trap is one of the most aggressive and high-impact reversal signals in price action. But here's the truth, most retail traders use it wrong. On its own, it's just a candle that swallows the one before it. But when it forms after a liquidity sweep or at a key level, it becomes a clear smart money footprint, a sign that the market is about to flip. Engulfing traps often appear at turning points, and when you know how to use them properly, they can tell you something powerful. The previous move is finished, and smart money is stepping in to reverse the market. But to use this signal with precision, you need to understand the two core types of engulfing traps and what they actually mean. Bullish engulfing trap. This signal usually forms at the bottom of a strong bearish move, often after a stop hunt or a sweep below a demand zone. The first candle is bearish, showing strong selling pressure. Then suddenly, the next candle is a powerful bullish bar that completely engulfs the previous one. This isn't random, it's a trap. Smart money lures in sellers, sweeps liquidity, then reverses direction, catching those traders off guard. When you see a bullish engulfing trap at a key level with confluence, it's a signal that buyers are back in control and the market is ready to move higher. Now flip the script. The bearish engulfing trap. This setup forms after a bullish rally, often just after price sweeps liquidity above resistance or taps into a fresh supply zone. The first candle is bullish, full of buying pressure. Then comes the trap, a strong bearish candle that wipes out the entire previous candle. This is smart money selling into strength, using the fake breakout to trap late buyers and then reverse the move. A bearish engulfing trap tells you the rally is over, the market is shifting down. Now let's apply the TLS method using the engulfing trap as a signal. Look at this chart. As you can see here, the market is clearly trending downward. We've just had a strong impulsive move in the direction of the trend, followed by a pullback. Now if we look to the left, we can identify a previous support level that has been broken and is now acting as resistance. This level becomes crucial. It's a potential turning point where we can anticipate the end of the retracement. Let's take it a step further and add the 50 simple moving average to look for confluence. However, as you can see, the 50 SMA is too far away from price, so it's not useful in this setup. That's when we bring in the Fibonacci retracement tool. We plot it from the swing high to the swing low of the impulsive move. Now look at the levels. The 50% and 61.8% Fibonacci retracement zone, also known as the golden zone, is what we focus on. Notice what's happening. The resistance level we marked earlier is perfectly aligned with this Fibonacci zone. That's a high probability confluence. What's missing? A signal, and here it comes, right inside the golden zone, and at our resistance level we get a clear engulfing trap pattern. This trap forms at a key resistance level. It aligns with the Fibonacci golden zone, and it confirms that smart money is stepping in to reverse the pullback. This setup checks all the boxes. The trend is clearly down, the level, a broken support turned resistance, lines up perfectly with the Fibonacci golden zone, and right at that spot we get our signal, a clean engulfing trap. Everything aligns for a high probability trade. Before taking the trade, let's zoom out and check the hourly chart to make sure the higher time frame supports our setup. On the 1 hour time frame, the market is clearly trending down. This adds even more confidence to the setup. Let's go back to the 5-minute chart and plan the trade. Here's how you would take this trade. You enter at the close of the engulfing trap candle. Your stop loss goes just above the high of the trap setup. The target, the next support level below, and always aim for at least a 2-to-1 reward to risk ratio to make the trade worth it. And look at what happened next. The market respected the resistance level, honored the engulfing trap, and dropped straight to our target, just as expected. That's the power of combining trend, level, and signal, with smart confluence using the Fibonacci tool. Alright, that brings us to the end of this video. If you've learned something new or this strategy helped you see the market more clearly, do me a favor, hit that like button, subscribe, and turn on the notification bell so you don't miss what's coming next. Thanks for watching, trade safe, stay sharp, and I'll catch you in the next one.